Hello everyone, a very good morning. Welcome to Oliveboard. I am Anshul, your CAIIB mentor, and this is the demo class for your BRBL cracker batch. So we have introduced the all-in-one crash plus cracker batch for the CAIIB November-December exam cycle for 2025, and we are very soon going to start with the cracker batch. In this particular batch, I hope you all would have started with your revision. We are going to revise, we are going to practice all the possible questions. So, MCQs that are specifically curated following your exam pattern, the latest exam pattern, the difficulty level, the types of questions, the changes that have been made by the institute in the exam. All right. So, everything, all the important topics, all the important questions will be covered in the live classes. So this cracker batch is going to be completely live. In live sessions, we'll be discussing these questions. All right. Now, if we talk about the type of questions asked in our BRBL paper, all your four papers are different. The types of questions, the difficulty level, the things that you need to study are different. In the BRBL paper, you'll be studying about so many acts, their provisions, sections, about the Companies Act, about the Partnership Act, Limited Liability Partnership Act, and not only fact-based questions on these provisions and sections, multiple selection question in which you'll be given a statement like this and this is the act, which of the following are true according to the section, and then you will be given 4 to 5 statements among which you will be choosing which ones are correct. And then most of the weightage is of the case studies and scenario based questions. These are 2 mark questions in which rather than directly asking you about the provision of the act, the institute gives you a scenario. You need to understand what the scenario is, what it is asking, and then you will be able to answer. Based on the scenario, the question is asked. So, fact based questions are there, multiple selection questions are there, and case study. Now, the total marks of the exam, the paper is 100, but number of questions need not necessarily be 100. It can be less than that. Why? Because 2 mark question, 1 mark question, and zero point 5 mark questions are also asked. The total marks, maximum marks is 100. The questions might differ, and you need to score 50 plus to qualify in the BRBL paper. If we talk about the weightage of the four modules, we have 4 modules in total. Around 30 units are there. These many acts are that you need to study. In your module A, regulations and compliance, basically the Banking Regulation Act and the RBI Act are covered. This module holds of a weightage of around we can say 10 to 15 marks. Direct questions that are section based, like what is the section 8 of the BR Act, what powers are given to RBI under section 42 of the RBI Act, in the section 35 double A, how does RBI regulate the banking business? Like this questions are there. In your module B, it is easy. 7 units are there. It is a very simple module, but it is important. So we can expect around 20 to 25 mark questions from our module B. The acts that are covered here are your FEMA Act, Negotiable Instruments Act, Payment and Settlement Systems Act, portion of the Transfer of Property Act, the mortgages, assignment, set off, bankers lien, these things are covered, and then the charges, registration of charges, modification, time period for that, all of these things. Module C is extremely important. We can expect around 30 mark questions from our module B. All right, 30 to 35 mark questions from our module C. Right, so units, we have to study the SARFAESI Act, the Recovery of Debts Due to Banks and Financial Institutions Act, the IBC, Insolvency and Bankruptcy Code, the Legal Services Authorities Act, Consumer Protection Act is there, Bankers Books Evidence Act is there, the Limitation Act. And then we have Module D. The weightage of Module D is highest in the case studies. Case study questions, scenario based questions, maximum they come from module D. So commercial and other laws, the Indian Contract Act, Sale of Goods Act, you'll be studying about the Companies Act, Partnership Act, the Limited Liability Partnership Act. All of these acts are covered in your module D. Module D and C are extremely important. So when you're starting, when you're revising, start with your module A, finish it. It is rather simple. Then move on to module B. You'll be able to complete it in 2 or 3 hours. And then module C and D. Devote the maximum time towards module C and D because case study questions are asked and these are scoring. If you understand how to solve the case studies, how to approach them, if you have a good knowledge, a clear understanding of these acts, you'll be easily able to score full marks in these case studies. All right, now what we are going to do in this cracker batch, because this is a demo session, I will be giving you a brief introduction, right? A sort of trailer, which type of questions will be asked, what we are going to do in our live classes. So the same thing that we have been following in our marathon classes. You will be getting a question on your screen. Now these questions are difficult. These are not easy. These are not direct. These questions are difficult. But when you practice these questions, you'll be easily able to solve them in 10 to 15 seconds maximum. And this is the maximum time that you need to give because you have 2 hours. You need to solve at least, you have to solve almost 100 questions, right? And you need to score 50 plus. So at least 50% of those questions should be correct. So approach the question with a calm mind. When you read the question, you should understand what is the correct answer. All right, so identify which of the following statements are correct. Banks must accept deposits only in the form of money, not valuables. Deposits accepted must always be repayable on demand. KYC norms enable the government to open zero balance account. Under certain conditions, individuals may be prohibited from using bank in their firm's name. Now, this question is from our Banking Regulation Act, our definition of banking given in section 5B of the act, right? According to the section, the banks they perform two functions: acceptance of deposits from the public, lending or investment of such deposits. Now, these deposits can be of money only, not anything else. That means only money and not any tangible goods. Tangible goods not allowed, it is a prohibited business. Goods will include every kind of movable property. Right now, there are also exceptions which are given in the section 8. So now you need to connect each and everything, right? Deposits acceptable by banks must always be repayable in demand, must always be repayable. Demand deposits are accepted, yes, under the section 49A, another important section. No person other than a banking company, RBI, SBI, is authorized to accept deposits withdrawable by check. But it is not the only type of deposit. So you need to read the question, the options very carefully. Otherwise, you would think that they're just asking you about whether they're allowed to accept, and you'll mark yes, this is correct. But this is not correct because the deposits can also be fixed deposit, recurring deposit, term deposit. So this statement will be incorrect. KYC norms enable the government to open zero balance account. KYC norms are meant for the proper identification. The accounts will be opened for the persons who are fulfilling these certain conditions. So statement 3 is incorrect. And fourth statement, yes. Banks, when they are starting their banking business, when they're getting their license under the section 22 of the Banking Regulation Act, another important section, license is to be obtained from RBI. So under this section, once they get the license, they have to use the term bank, banker, banking as a part of their name. No other firm can use this name. However, subsidiaries of bank, association of bank, certain primary credit societies, a cooperative society, they can be exempted from using this term. They are exempted from this restriction. So correct statement is 1 and 4. And everything that we just discussed related to this question, I will also include it in the explanation, so that when you are revising, you can go through this explanation and understand the correct answer. All right, so here the correct answer is D, 1 and 4. Right? Fact based direct questions are also asked, like which of the following matters can an aggrieved banking company appeal to the central government? So, when we read this question, automatically it should come in our mind that government as a regulator of bank has been given certain powers under the section 7 of the of the RBI Act, right? Section 7 of the RBI Act. Under the BR Act also certain powers are given. All right. Under Section 7(1), the central government can give certain directions to RBI which have to be rarely be done. These powers are to be rarely used. Only once they have been used, if you remember, in October 2018, related to the liquidity of NBFCs, capital requirement for weak banks, lending to the SMEs, right? Powers are also given under the Banking Regulation Act, like under Section 36AA of the Banking Regulation Act, appeal against removal of managerial personnel. If RBI has removed a managerial personnel from the bank, they can make an appeal to the government. Similarly, appeal against cancellation of banking license, refusal of certificate regarding floating charge or assets, suspension of operations, exemption from any provisions, right? So all of these are the areas where the bank or the aggrieved person can make a can make an appeal to the central government. So here, yes, the correct answer will be B. It is the cancellation of license under Section 22. All of these powers that have been given to the central government under the RBI Act and BR Act, you need to understand it. All right. Next, I also told you that case study type questions are asked, scenario based questions are asked. So here's a scenario. Prudence Bank, under a 4-month court granted moratorium, is found to be operating in a manner that could harm the depositor's interest. According to RBI's internal audit, what action can be taken by RBI and what happens to the moratorium? Now, cancellation of license, amalgamation of the bank, merger of a bank, winding up of the bank, these decisions can be taken by RBI. Central government also has the power to order it, to prepare the scheme. Now, if a moratorium is given, moratorium means a stay on proceedings. Let's say the bank applied, RBI granted that a stay on proceedings can be done so that the bank can recover, so that the bank need not be wound up. In that period of moratorium, certain restrictions are there. Those are not being complied with. The bank is operating in a manner that could harm the depositor's interest. What can the RBI do? RBI can direct the bank to restructure itself without informing the court, or it can apply to High Court for winding up. The moratorium cannot be extended any further. RBI has no authority during a valid court granted moratorium. The court must wait until 6 months to consider winding up. Now, definitely, the court, the High Court, has the powers, the authority to order a moratorium. They can themselves do it, or RBI can recommend. But if the bank is doing something that is detrimental to the depositor's interest, they can apply to the High Court, and the High Court will have to follow this application. The High Court will now take back their order of moratorium and it will be wound up. The bank will be wound up. All right. So the correct answer is B. So the whole scenario is given to you. The question could be asked in a direct manner as well, right? Like what are the powers of RBI regarding moratorium, or what are the powers of High Court regarding the moratorium, declaration of moratorium. Okay. But RBI can cancel it in this scenario based question. Under Section 45 of the Banking Regulation Act, The RBI can apply to the central government for an order of moratorium, and this may also be if the total period of moratorium can be extended to 6 months at a time. In this period, the company shall not make any payment to the depositors or discharge any liabilities or obligation to any other creditors unless directed by the central government. All right, this is the provision. Next, what constitutes an offense under the section 138 of the Negotiable Instruments Act when a check is returned unpaid? So the question is asking you specifically about the section 138. So what is the section 138? A check is returned due to insufficient funds in the account. A check is presented after 6 months from the date it was drawn. A check is returned due to the drawer's instruction. A check is presented within 3 months from the date it was drawn. So all of these scenarios are correct. All of these scenarios are correct for the reasons that the bank could reject the payment. It is a post dated check, it is an expired check, the drawer has instructed for the stopping of the check. But section 138 talks about when the check is returned due to insufficient fund. This is known as dishonor of check, and it is an offense, right? They're tried under section 138. It is a criminal offense. Okay, so when any check drawn by a person on an account maintained by them is returned due to the reason that the amount of money standing to the credit is insufficient or it exceeds the amount arranged to be paid, such person should be deemed to have committed an offense. All right, they can be punished with an imprisonment for a term extended to 2 years with a fine extended to twice the amount of check, or both. Now there's the whole proceeding process. The drawer, if they plead not guilty, they can apply it to the court. The court will hear both the parties and then they will give the decision. Interim compensation, final order, section 143A, section 148, very important. All right, again, a scenario is given. XYZ Private Limited, a fintech company, has developed an innovative payment gateway enabling instant cross border transactions. Eager to launch its operations, the company begins facilitating transactions among its users. However, upon scrutiny, the RBI notices that it was operating without authorization under Section 4 of the Act. Which Act? The Payment and Settlement Systems Act. The company argues that it qualifies for an exemption under the Act's provision. But RBI must decide whether it can continue operations or it must cease until authorization is granted. Now, if any entity wants to set up and provide the functions of the payment system provider, first they need to get authorization of RBI. There are three sections regarding it: Section 4, Section 5, Section 6. Right? Section 4 says no person other than RBI can operate any payment system without the authorization of RBI. Then Section 5, where the person has to apply for authorization. Section 6, RBI conducts the scrutiny. Section 7, the authorization can be given or it can be refused. Now, here there are certain exemptions. There are certain exemptions that if these things are there, they need not apply for the authorization, right? But just because it has developed an innovative payment system, they cannot have the exemption. If the company is operating as an agent for another entity, this is an exemption. If a company is accepting payments from its holding company or fellow subsidiaries, exemption is there. The company has obtained explicit exemption from RBI via notification, but just the reason being that they have developed some innovative technology will not be an exemption, right? So the question is saying which of the following exemptions would not apply. So if any of these three things would have been there, the company would have been exempted. But that's not the case. So the correct answer will be D. RBI has the powers to cancel their operations. RBI will have the powers to impose penalty on them. Okay, all right. Next, which statements are true about a hypothecation as per the Surface Act 2002? Hypothecation is defined under the Surface Act. Other, like mortgage, is defined under the Transfer of Property Act, all the types of mortgages. Then assignment, set off, these are defined under the Indian Contract Act. But hypothecation is defined as per the Surface Act. Which statements are correct? It includes a floating charge and crystallization of charge into a fixed charge on a movable property. It involves transferring the possession of the movable property to the creditor. It is a charge created by a borrower in favor of the secured creditor. It excludes any future immovable property. So hypothecation is a charge created on movable property. True. It is a floating charge in the sense that it is a general charge. It is not fixed on any particular property. It can be, but it can also be a floating charge, right? It can be existing, it can be future without delivery of possession of the movable property to the creditor, right? Neither physical nor legal, and this will act as a security for financial assistance. It includes floating charge, and if the borrower defaults, then it will be crystallized into the fixed charge, and the creditor will now have the specific interest. So I hope you know the correct answer now. It is 1 and it is 3. 1 and 3. So the correct answer is A, right? It includes future movable property. See, hypothecation is beneficial in certain cases. Let's say the goods need constant handling. It is a machine. It needs constant handling. It is to be raised. The loan is raised against work in progress, right? Then the charge is convenient when the lending is done against goods in a shop or a showroom, which are required in a day-to-day basis. So hypothecation is important there. Okay, next. Which of the following statements accurately describe the procedural framework for initiation of the corporate insolvency resolution process by a financial creditor under the Section 7 of the IBC? So the question is clearly telling you under Section 7 of the IBC, you need to identify the correct statements about the CIRP. The financial creditor may file an application for initiation even in respect of debt owed to another financial creditor. Yes, this is the exact thing which is given in the section 7 subsection 1. Default may be in respect of any financial creditor, and we are talking about the corporate borrower. For allottees in a single estate project, a minimum of 100 allottees or 10% of the total allottees, whichever is higher, must file the application together. Now, in the first glance, it might appear that the statement is correct, but a very minute thing, that whichever is higher is not correct, whichever is lesser. Whichever is less is correct. So the statement 2 will be wrong. Then the statement 3, an application filed prior to 2020 must comply to the joint filing requirement within 30 days. Yes. The CIRP begins from the date of filing the application before the adjudicating authority. No. The CIRP begins on the admission of application. This is section 7, subsection 6, right? We might file an application on a particular day, but the application is admitted by the adjudicating authority on some other day. So, on that day, when it is finally accepted, the CIRP will begin. So, the correct answer is 3, option A, 1 and 3 only. Why the other statements are correct or incorrect, that also is given in your explanation. All right, so these questions are lengthy, they are time consuming, but please read the statements very carefully. Do not be in a hurry to answer them. Read the questions correctly and then answer them correctly. All right. Next, what does the previous year mean according to the section 3 of the Income Tax Act 1961? So there are two classifications. There's the financial year and there's the assessment year. Financial year or previous year mean the same thing. Assessment year, when we are filing our ITR, we select the assessment year in which we are filing the ITR, in which we are paying the taxes. That is the assessment year. We are paying the taxes for the income that we have earned in the financial year or previous year. So right now the current assessment year is 2025-26, and the previous or financial year is 2024-25. That is the financial year immediately preceding the assessment year. It is the previous year. In this year, the previous year or financial year, we are earning our income, and in the assessment year, we are paying taxes on it. All right, now there's the whole provision related to it. If a new source of income comes into existence in the middle of the financial year, how do we compute the financial year? How do we take into account the income? All of these things are there. All right, so the correct answer is B. Next, Zenmart, a leading e-commerce platform, advertises a new range of eco-pure air purifiers, claiming that these devices eliminate 99.9% of airborne pollutants through a patented filter technology. However, consumer watchdogs discovered that the purifier uses HEPA filters, which are widely available, not uniquely patented. In another instance, Zenmart lists an expensive limited edition smartwatch for 20,000, declaring only 50 units available. Investigations found that actually more than 5,000 units were sold at this price, contradicting the exclusivity claim. A group of dissatisfied buyers filed a legal complaint, arguing that they were misled by scarcity. So, does Zenmart's purifier advertisement violate Section 247? We are talking about the Consumer Protection Act of 2019, which aims to protect the consumers from any unfair trade contract, unfair trade practice, right? So whenever there's a wrong information in the market, the trader is doing something which can hamper the rights of the consumers, the right to be informed about the quality, quantity, purity, standard, the right to be assured, the right to be heard, the right to seek grievance redressal. These are the rights. If these are breached, action can be taken against the trader. So this is the meaning of unfair trade and unfair trade practice, which is given in the section 2 and section 2, subsection 46 and subsection 47. All right. So here the does it violate section 247? Yes, because they falsely claim a patented technology and it constitutes a deceptive marketing. So, if the unfair trade practice, if we are talking about the unfair trade practice, falsely representing that the goods are of a particular standard, that is what this particular company did, falsely representing that the services are of a particular standard, representing any rebuilt, second hand, renovative, reconditioned old goods as new, representing that the services have sponsorship approval when they do not have, making a false or misleading representation, gives to the public any warranty or guarantee, which is again not true. All right, so these things are there, and yes, both the conditions are false. The quantity in the second situation was misleading, and the quality in the first situation was misleading. So, yes, they violate section 247. Section 2, subsection 47. Okay. Which of the following statements correctly describe the concept of common seal and corporate veil under the Companies Act 2013 and related jurisprudence? Now, the Companies Act is very important. It is quite lengthy, and more than 4 or 5 questions were asked in the previous exam. So make sure that you revise the Companies Act very thoroughly, right? What is the company, the memorandum association, the articles of association, the types of companies, directorships, number of directors, whole-time director, part-time director, all of these topics are important. Talking about the corporate wheel and common seal. Now, a company, it is a separate legal entity, but it cannot sign because it is an artificial legal person. So, for that reason, a common seal is utilized for signing the contracts. Corporate veil means there's a curtain between the people who are actually managing the company and those who are the directors of the company. All right, so there's a difference between them. So, what are the provisions? The use of common seal is mandatory for issuing certificates. The corporate wheel may be lifted by courts in cases involving fraudulent contract. A company may be held criminally liable despite being an artificial person. A corporate wheel doctrine applies strictly, cannot be pierced unless expressly provided under the Companies Act. So, a corporate wheel used, a common seal definitely used to be compulsory, but now this is amended. After the 2015 amendment, it is optional. So first statement will be incorrect. Second, corporate wheel may be lifted. Yes, if there is a misconduct involved, if there is a dispute involved, the directors of the company have been involved in insider trading, the court can lift this wheel and reveal who is actually behind this action. So it can be lifted, it is correct. Third statement, the company can be held criminally liable. Yes, it is an artificial but a legal person, a separate entity, a separate legal entity. So the third statement is also correct. Now, is the fourth statement correct? No, because it can be pierced. The corporate wheel can be pierced. We can see which people are behind certain actions if the court directs. Right? It should not be expressly provided under the Companies Act. So the correct answer is B, 2 and 3 only. Only 2 and 3 statement are correct. Another case study, the Articles of Association of MNO Limited restricts the managing director from entering into contracts exceeding 1 crore rupees without prior board approval. Now, there's a difference between memorandum of association and articles. Memorandum of association are the basic things. There's the name clause, registered office clause, there's the activities which the company might carry out, right? The memorandum of association will give the information to outsiders about the doings of the company, what the company is involved in. Articles is internal. The articles of association is for the internal management of the company. So the internal rule said that the managing director cannot enter into contracts exceeding 1 crore without board approval. Despite this, the managing director signs a supply contract of 2 crores with Z Corp. The board later denies liability. Z Corp claims, files a suit, and the board later denies, saying that the managing director did not take our board approval. So this contract is invalid. However, Z Corp claims it, assuming that the managing director had the power to do so. They had no idea about this prior board approval requirement. There were no suspicious circumstances to believe that the managing director did not have power. Which principle is most relevant to determine the company's liability? Is it the doctrine of ultra vires, indoor management, constructive notice, or the doctrine of lifting the corporate wheel? So the doctrines are very important. The doctrine of ultra vires means intra vires within the powers of the company, ultra vires beyond the powers of the company. A company cannot sue on an ultra vires transaction, nor it can be sued against them. But here, the company was allowed, the company as a whole was allowed to take 2 crore rupees contract. So it is not ultra vires. All right, so this will not be true. Then doctrine of indoor management says that whatever is happening inside is not the matter of the public, right? Doctrine of indoor management protects the management, right? A person who deals with the company is deemed to have read and understood the registered public documents like the MOA and AOA, and then they should enter into the contract, right? But that third person is not bound to inquire into the regularity of the internal functioning. So if they read the AOA, it was given that the managing director will approve such loans or transaction only after the board approval. The third party will believe that such contract is done by having the board approval, right? So if the contract is consistent with the public document, the company is bound by it. The third person will not be affected by the irregularity in the internal management. This is known as the indoor management, and this is the correct answer. So the indoor management protects outsiders from the internal inconsistencies of the company, right? On the other hand, there's the doctrine of constructive notice, which protects the management, right? It protects the insiders of the company against the dealings with the outsiders. All right. So that is constructive notice. So the correct answer is B, and that is all for today. So this was your demo session. I have shown you the types of questions that will be discussed, the difficulty level that we'll be practicing, and all of this will be in live classes. So you'll be getting live sessions for all your papers, for all your four compulsory papers. So you have the option to enroll to the CIB Super Elite Plan, all in one plan. You'll get access to the foundation, the crash and cracker, capsule batches, everything under one plan. Or you can subscribe to the CAIIB all in one combo, which is the crash and cracker batch. You'll be getting the crash batch in the live and recorded version, and the cracker in completely live. 100 live practice sessions will be there. High level MCQs, case studies, you'll also get access to the mock test, and revision sessions for your crash batch as well will be included here, right? So like I told you, this batch is going to be in complete English medium. All your four papers will be covered by your mentors in English medium, content and explanation, everything, right? So in this thing cracker, we'll be only discussing the MCQs, the questions in the live classes. And if you enroll now, you can avail the Shehra Dhamaka offer. You can avail flat 60% off on your CAIIB plans. Simply use the code FEST to avail this benefit. You can go to the Oliveboard website, you can download the app, and under the courses you'll get this super elite plan as well as the all-in-one combo. So subscribe now. The offer is ending on 3rd of October. Start your preparation. Your exams are very close, and now very soon the festivities will also start. So there at that time it might be a bit difficult for you to study. So start early, right? And all of these important sessions will be conducted here on the YouTube channel as well of the JIB CIB English Medium. So make sure you like the video, share the video, and subscribe to the channel. So thank you so much. You will get the PDF. You can download it from the website. Thank you so much. All the best.